Hi, this is Geof Marshall, and this is the Q4 update for Signature High Income Fund. And as always, these comments also largely apply to Signature Diversified Yield. What had the greatest impact on the fund in the last quarter? The combination of compelling beginning valuations, a favorable monetary and a favorable fiscal policy backdrop, meaning very accommodative, improved risk sentiment post-vaccine news, and the uncertainty of the U.S. election behind us pushed the markets in our target asset classes, namely high-yield bonds, real estate, and infrastructure equities higher, and then great security selection drove fund outperformance. Like the full year period, outperformance was generated in all three asset classes, while only the depreciation of the US dollar was a slight drag. Notable outperformers in Q4 were Brookfield Asset Management and Cheniere, while our real estate holding Prologis was a slight detractor, in stark contrast to its very strong performance over the prior 9 months. In December, we began the process of lowering the high-yield weight in the fund further by 5% to 35%, allocating the proceeds mostly to what we consider other equities, namely, in this case, Canadian banks and U.S. healthcare stocks. And we're doing this as our base change has changed actually a little bit at the margin. As it stands, we see an environment of low but rising inflation, more so in the commodity space than in wages, low but rising nominal interest rates, but still real government bond yields, meaning after inflation, negative, and central banks like the Fed and like the Bank of Canada determined to keep them there. We think another stimulus package from the incoming Biden administration and vaccine deployment is largely fully priced into the credit markets, and so that part of the fund will be more about carry or just earning your yield than about the possibility for real price gains in 2021. So it wants us to be overweight credit or corporate bonds versus government bonds in the fund in 2021, but more so over equities versus over credit or over bonds within the fund. And then within equities, we like our high dividend sectors, which we think actually aligns with investing in real estate and investing in infrastructure. We particularly like midstream energy, so like pipelines. And then we like financials. We think financials can benefit from a steepening of the government bond yield curve. And then cyclicals. We think cyclicals will be in favor as investors generally are preoccupied or focused on the reflation trade in 2021, which we expect to be very much with us throughout 2021 as the economies gradually reopen over the course of the year. I'm Geof Marshall. I'll speak to you next quarter.